All right, let's get right into it. We are going so far beyond the headlines today to really unpack a market signal that honestly, most people get completely backward. This isn't just another explainer on what an inverted yield curve is. No, this is the playbook for what happens next. That crucial moment when the curve starts to look normal again. And this quote, this is the entire game right here. It's one of those things that just doesn't feel right at first, but it is a fundamental truth about how market cycles actually work. The loudest, most important signal isn't the inversion itself. It's the moment that inversion ends. And that's where you'll find both the biggest risks and, for those who are prepared, the biggest opportunities.
Okay, so before we can even touch the playbook, we've got to make sure we're all speaking the same language. We have to get our definitions straight, starting with the one signal that grabs all the headlines and, frankly, causes all the confusion.
Right. This is the famous one, the harbinger of doom. Think about it. Normally, you should get paid more for locking your money up for 10 years than for 3 months. When that flips, the bond market, the so-called smart money, is basically screaming that the short-term future looks incredibly shaky. I mean, this signal has an almost perfect track record of predicting recessions over the last 50 years. But here's where the real story begins. The moment the curve starts flipping back to normal, that's called a bull steepener. Steepener because the gap between short and long-term rates gets wider or steeper. And why bull? Well, it's driven by the Fed cutting short-term rates. And if you're holding an older bond with a high interest rate while new ones are being issued for way less, cha-ching, the price of your bond just went up. That's a bull market for you.
So why are we focusing so much on this one specific moment? Why is this bull steepener such a massive deal? Well, let's pull back the curtain on the mechanics here, because this is exactly where the money is made and where it's very, very easily lost. And this right here is the single biggest mistake that investors make. They see the curve going back to normal and they think, phew, crisis averted. But it's the exact opposite. Think of it less like an all-clear signal and more like hearing ambulance sirens. Sure, help is on the way, but it also means there's been a really bad accident. The Fed is officially reacting to an emergency.
You can see how this plays out, right? It's like a script that runs every single time. First, the bond market smells smoke and inverts the curve. That's the early warning. Then, months later, the Fed finally sees the flames in the official data and starts spraying water by cutting rates. The uninversion? That's just the Fed finally catching up and confirming, yep, the market was right. We've got a problem.
This quote just nails it. The Fed isn't leading the charge here. They're reacting to a fire that's already burning. When they start cutting rates fast enough to uninvert the curve, they're tipping their hat, they're showing their cards. Whatever you want to call it, they are publicly admitting that a recession is no longer a forecast, it's here. Okay, so now that we get the why, let's talk about the what. What do you actually do with this information? Let's start with the bond market, because this whole sequence sets up a really classic, and if you time it right, a very powerful trade. Now, the key here is that you don't wait for the uninversion to happen. The pros, the smart money, they see the deeply inverted curve as the starting gun. They use the inversion itself as the entry signal because they know exactly what's coming next, the inevitable Fed pivot. So here it is, the two-step dance. Step one, while the curve is inverted, you buy long duration bonds to lock in those juicy yields. And long duration is the magic phrase here. Think of it like a long wrench. It gives you more torque. A tiny move by the Fed to cut rates can create a huge upward pop in the price of these specific bonds. And this just boils it all down perfectly. You buy the bond to get paid a nice high yield while you wait. But that's not the main prize. The real win is the capital appreciation, that nice premium you get when the Fed is finally forced to act. You buy for the income, you sell for the profits. Okay, that's the bond playbook. Seems pretty clean, right? But what about the other side of the portfolio? What about stocks? Oh boy, this is where things get really tricky. And frankly, where most people get absolutely burned. So to even begin to understand the stock market piece, you have to talk about banks first. And for banks, it all comes down to one little acronym, NIM, or net interest margin. Their whole business model is borrowing short-term from you, your savings account, and lending long-term, like a mortgage. An inverted curve absolutely crushes this model. But the second that uninversion happens, that bull steepener, for banks, it's like hitting the NOS button on profitability. All of a sudden, their borrowing costs plummet, while the interest they're getting on their old loans stays high. That profit gap, their NIM, just explodes. And that's often why you see the financial sector start to take off right around this time. But for pretty much every other stock,
The uninversion is a huge warning sign. It kicks off what we call the Great Equity Shuffle. The Fed cutting rates confirms the economy is weak, so capital just bolts from high-flying growth stocks. Why? Because a recession means those dreamy, far-off future profits, well, they might not happen. It's a classic flight to safety. So when we say defensive, what are we really talking about? It's simple. Boring is beautiful. We're talking about companies that sell stuff people have to buy, recession or not. You're not going to stop buying toothpaste or turning on your lights, right? Their earnings are rock solid, and in a storm, that's exactly what investors are looking for. And this brings us to what might be the single most important part of this whole playbook, understanding and avoiding the one critical mistake that traps so many well-meaning investors every single time this happens. Here's how the trap works. The curve uninverts. Those popular high-growth tech stocks start to tank. And what does everyone who's been conditioned for over a decade do? They buy the dip. But this time it's different. It's not a dip. It's the beginning of the slide. They're trying to catch a falling knife because they think Fed rate cuts are the cavalry coming to the rescue. But history shows us the rate cuts are the final warning. And don't just take my word for it. Let's put a number on it. This is straight from the data. On average, the S&P 500 has fallen 23% after the Fed has already started cutting rates. Just let that sink in for a second. The rescue is often when the real pain begins for the stock market. And this isn't some random fluke. It's a pattern. Look at the dot-com bust, the 2008 financial crisis, even the flash crash in 2020. The story is eerily the same. The Fed starts cutting, and the market often proceeds to have its worst moments afterwards. The cuts don't stop the pain, they just confirm the diagnosis. So let's bring it all together. The uninversion is not an all clear. It's two completely different signals for two different asset classes. For the bond market, it's the sound of the cash register. For the stock market, especially those risky growth sectors, it's the final fire alarm, telling you the damage to corporate earnings is really just getting started. Look, the patterns are all there. History has literally laid out the playbook for us in decades of data. The hard part isn't knowing what it says. The challenge is having the clarity to read the signals correctly and the discipline to actually act on them when emotions are running high and the entire crowd is screaming at you to do the opposite.